Good afternoon, High 10 George Realty. What a pleasure it is to be hosting this Lunch and Learn. It is chock full of a lot of good information. I am going to let Yolanda from WFG Title do the introduction, so I will turn it over to her now.
Hello, everyone. Hello. Hi. Thank you so much. Wow, full house. This is exciting. Thank you so much for taking the time from your busy schedule to come out today. And I tell you, you're going to enjoy this presentation. Like Michelle said, my name is Yolanda Martinez Arenas, WFG National Title Company. I love education. I love classes. I love knowledge. And I'm so proud to introduce my friend Adrina from Exchange Resource Inc. But a little bit about Adrina or the company first. My husband and I, we've already have done business with this wonderful company. We've actually done 2 1031 exchanges, and we'll be doing another one soon. We'll be contacting you. So I speak from the heart and let you know that this company is awesome. And Adrina is a hardworking lady. I just found out about a couple months ago that she was an escrow officer and a realtor. So what a resume. I mean, what a resume, right? Talk about knowledge and full concept of a transaction. She has it. And along with Adrina today, she brought a wonderful, her company, her stuff, Michael and Chris, who she'll do some introductions and onto the presentation. But without further ado, I'm going to turn it over to Adrina so she can introduce the speaker. Thank you so much. Enjoy.
Thank you, Yolanda. Yolanda, you're always so kind. Hi, everyone. It's good to be back here with all of you again today. Today we're going to be talking about advanced 1031 strategies, which includes DSTs. So Chris Rogers from JRW Investments is here. He's the Director of Due Diligence, and he's going to dive into the topic of DSTs with you today. The one thing I want to remind you again, because we had a conversation earlier, the 4 qualifying questions we want to ask the client, an investor, is, are you selling an investment property or a property used for business? And is your intent to buy investment property or property for business use? Have you held it for at least 2 years? And do you plan on holding on to the new property for at least 2 years? Now, that's number 1 question. Number 2 question, we want to talk about values. We want to make sure, in order to fully defer their capital gains, that they're going to buy for whatever they sold for. So the values are important. Number 3, tax ID number of the entity or the person that sells must remain the same when they conclude the exchange on the replacement property. So number 4 are the strict timelines. 45 days from the day after close of escrow to identify, and 180 days total from the day after close of escrow to close on the new replacement property or properties. Again, I'm here for any consultation. It only takes a few minutes to go over the scenario, go over the qualifying questions. Please reach out to me with any questions you might have regarding 1031 exchanges. We have a wonderful staff in the office ready to help and guide you and your clients through their next 1031 exchange. We also do reverse exchanges and build-to-suit exchanges, in addition to the delayed exchange. My cards are here, and without further ado, I would like to introduce Chris Rogers from JRW Investments, and we'll talk about the FTC. Thank you.
Thank you, Adrina. Thank you, Adrina. Thank you, Michael. It's so great to be here with you guys. So today what we'll be covering is a few different topics, primarily around the real estate investor and around the Delaware Statutory Trust. By way of background, my name is Chris Rogers. I work with JRW Investments, and I'm the Director of Due Diligence at the company, but I'm also a registered representative. So I'm securities licensed financial professional and advisor, and I work with clients representing different types of securities and understanding their goals and their objectives. By way of background, and we'll go to this slide. This is perfect. So what we'll be covering today are tools and strategies that we've used since 2004 on behalf of our clients, and even earlier in some cases. This is by no way a broad recommendation for any of your clients or for yourselves. This is mainly meant to be educational and tools in nature for you just to have in your tool belt when you're working with clients and investors. The next slide.
Next, okay.
So there's primarily 3 goals for this presentation. I want you to learn something, I want you to remember something, and I want you to feel something. Learn, I want you to understand and demystify the Delaware Statutory Trust for you. This is a vehicle that owns real property that qualifies for 1031 exchange. So all what Adriana is talking about, this qualifies as like-kind property and can satisfy that requirement. Secondly, remember, there are generally 60 to 100 passive real estate investments available for 1031 exchange throughout the United States. So JRW, we exist to evaluate these properties, identify the best opportunities, and make recommendations that fit the goals and needs of clients. Third, I want you to feel empowered. So empowered to act. And we're going to go into this a little more, but I think today there are so many real estate investors who are transitioning from active management to passive. And maybe that's a little bit cart before the horse a little bit. There's primarily a lot of investors who are aging out of wanting to manage actively. And oftentimes, if they've owned real estate for 20 or 30 years, there's a large capital gain built in, so they may feel stuck. So we're going to unwind a little bit of how we serve that type of investor. And if we can leave you with tools to feel inspired to work with that type of client, to be able to serve that type of client, that would be a huge win. So JRW Investments started in 2003 as it is known as JRW. Prior to that, we were a longstanding CPA practice. We're just over in, maybe not just over, I live in Ontario, California with my wife, so everything feels somewhat close because we're always driving, but we're in Pasadena, California off of Colorado and Wilson. There's a 3 or 4 story white building there that's where our office is located. Prior to JRW, we were a longstanding CPA practice founded by Warren Thomas. So he's a longstanding CPA, master's in taxation. That was started in the early 80s. And then in the 90s, we layered on financial planning for clients. As most CPAs who have an intimate understanding of a client's taxpayers, financial situation, layering on those was offering just more services. And then we sold the practice off in the early 2000s. And now we predominantly work with real estate investors through their 1031 exchanges, through real estate investment strategies. Now, where do we fit in light of an investor's team of financial professionals? So we are not a lender. We are not a financial advisor that represents stocks and bonds or mutual funds. We are not an attorney. We're not the CPA, and we're not the listing agent or the broker. We find ourselves somewhere in the middle of all of these. But we want to complement the existing team of professionals that an advisor or a real estate investor already has with them. Again, and I'll keep going back to this, our expertise is in real estate, and we pull from our background as a CPA firm historically, understanding the need for the 1031 exchange and understanding how can we solve complex problems for real estate investors. It's our passion at the heart of everything we do to empower people to be secure, free, and generous. And that generosity piece is a thread that I'll keep pulling on throughout the presentation. Everybody is thinking about this transition from active to passive at some point. And for our clients, they generally are going to have this generosity piece where they want to either be generous with their family. And that's why you want to do a 1031 exchange, right? You get long-term tax deferral of your capital gain of your real estate property, and you can use those pre-tax dollars to then reinvest and then earn income pre-tax. So it's an amazing wealth creation tool. But then secondly, be generous with their family or their church or their charity or their trust. So these are tools that really help with the generosity piece, and we keep going back to that in terms of our passion for our clients to meet their needs. The purpose of JRW is to source the right real estate investments. So at the bedrock of everything we do, we have to find quality real estate investments that meet the needs and goals of our clients. So predominantly capital safety, giving predictable income returns. These are all things that our clients are looking for. And if we get the real estate piece wrong, then that's detrimental to a client's overall financial plan. So it's critical to understand where are the right real estate investments and how do they fit a client's goals and needs. So I talked about already a little bit of the tax expertise historically. We also take into consideration macroeconomics. So we want to understand the forest through the trees. We want to understand where we are in the economy, where interest rates are at, where inflation's at, what the Fed is likely to do. Now, we don't have a crystal ball and we can't, understand that and guarantee that. But that all helps us understand what types of real estate investments to select for a client, for their goals and their needs. And then lastly, the due diligence. And I'm biased. I lead the department in due diligence. That's truly the kind of that is my heart, like behind like what I love to do. I feel like I'm in a very lucky position where I get to advise investors, work with clients, but then also lead a lot of the underwriting and evaluating of investments for our clients. So today, again, there are a lot of folks who are transitioning from active to passive. That could be in their jobs or it could be in their real estate. And today, 2025, 11,400 Americans will turn 65 each day. That's incredible. Never have we ever had a time where more people were transitioning in that phase of their lives. In 2024, over 4.1 million Americans turned 65. So 65 is the average age when people start to seriously consider this lifestyle change. First, it starts with their job, then it starts with other types of their life, whether it's their time commitments or it's their investments, etc. Now, it is estimated that more than 23 trillion of silent generation wealth is held in real estate. So that is an enormous amount of wealth. And it also creates an enormous opportunity to be able to serve those types of clients and investors. And that also, though, means that there's never been more people talking about it. So it's never been more of a competitive environment to try and get listings from real estate investors. Everybody in the real estate investor circle knows that they own properties. And it's typically going to be their friends and their families and their CPAs and their real estate agents. Everybody knows. So how do you distinguish yourself as a listing agent to be able to get those listings? And I think really it's understanding the transition of this wealth and being able to talk to the 1031 exchange. You know, talk through how are your assets performing? How can you transition from active to different stages of life, whether it's out of the state of California or it's into better cash flowing environments. Those are all things that investors are talking about. So I like to say a real estate investor at any one point in time has three options. You can hold, you can sell, or you can exchange. Today, by not selling your real estate, you're implicitly just holding your real estate. And that may be what is best for your client. Perhaps they're getting a great cash flow. Perhaps they like their tenants. Perhaps it's a great location, or perhaps their kids want to manage long-term. That can be a great solution long-term for that family if they just hold. Secondly, it's sell. So the question is do they, oh yeah, this slide can go back. Yeah, so secondly is sell. Is this the right time to sell? If I were to sell, what is my capital gain? If I were to sell, what other opportunities exist outside of this real estate or this market for my financial situation, goals, and needs? And then lastly, you have an option of exchanging. And the 1031 exchange is an incredibly powerful tool for wealth creation. Shameless plug for Exchange Resources. Our firm has worked with them for multiple decades, and we probably do 300 to 500 exchanges a year on behalf of our clients. Now, we're not the intermediary, but our clients are actively doing exchanges. And Exchange Resources, time and time again, is the best swap intermediary that we have worked with. I've worked with them personally with my family members and close clients, and they do an amazing job. So I would say you're in great hands using them for the 1031 accommodator. So the first question is hold. And the question I have for any investor is your asset performing optimally? There's a financial metric called cap rate. Cap rate or capitalization rate is the net operating income of that property relative to the fair market value. Now, you talk to a lot of investors and they'll say, well, my cap rate is really high based on what I paid for the property 30 years ago. Of course it will be. However, I would dare to say that their cap rate based on fair market value is going to be in the low 3s or 4s in California. That's predominantly what we see for cap rates across a lot of California real estate on a fair market value. The reason is appreciation has well exceeded any type of income growth. That could be driven by, rent control or rent restrictions, maybe just having long-term tenants in place. But those are reasons why your cap rate in California is going to be low. But the question is how is your property performing? And if the cash flow is great, then that's a great thing for that client. And we're really upfront about saying, hey, you cannot get actually better than what you're getting today. You're in a really good spot just to stay in this position, in this real estate, holding this property. The second question we have is, who do you think will sell your properties? When and why? And this is a pretty impactful question, because you think about it, a taxpayer, they've owned the real estate for 30 years and they have kids or they have grandkids or they have a trust set up. Somebody's going to sell that property. Or maybe they have 5 properties and they have 10 grandchildren or 10 beneficiaries. Someone's going to sell that real estate. Is it going to be you, or is it going to be your kids, or is it going to be your grandkids? And maybe you think the taxpayer thinks through that scenario and they say, hey, I want my grandkids to sell this property. I know they want to manage. Then they should do that. Like, that's a great long-term solution. But I think a lot of investors don't think through those 3 questions. A lot of them think, well, I'm going to pass away and they're going to figure it out. Well, time and time again, we see it. It's a mess. If you're trying to, at least if you get caught off guard by that. Because if you think about 6 different beneficiaries trying to decide over multiple properties, it's just a headache. So I would ask about that. That's a good question to ask. Who's going to sell your properties and why? The next question is on sell. If you were to sell, what are you going to owe in capital gains? So this would be covered in a lot of 1031 kind of just ordinary classes basics. But you're going to see if you were to sell, your sell price can determine your capital gain by comparing that to your tax basis. So your sell price is going to be different than what your purchase price was, right? So if your sell price is above what you pay for the property and above your tax basis, then you're going to owe capital gains. And if you were to not do a 1031 exchange, you're going to, that's what we consider a permanent tax loss. So those are things that we ask and consider. If you were to sell, what are the implications of that? And in California, you owe depreciation recapture, state and then federal. California is, I think, amongst New York, has the highest tax rates on a state level. So this is an extremely, you get hit with a lot of tax liability as a California resident. If you're in Texas, then you're just going to hit with federal and depreciation recapture. But in California, you're going to see significantly higher tax liabilities compared to other states across the United States. And then lastly, are you confident your properties are performing optimally? Remember, I asked that question earlier. And the 1031 exchange, what we do with clients is give them an apples to apples comparison of, this is how your property is performing today. This is how your property would perform if you invested out of state, or if you invested into a Delaware statutory trust fractional interest property. And that helps them understand their current situation relative to what is possible in their exchange. Common motivations for 1031 exchange include defer, eliminate capital gains tax. Other common motivations include the needing to replace a loan. So if you think about it, you sold a property for $2 million and you had a $1 million note or loan on the property, and you have $1 million equity left over. You actually don't. Some investors and taxpayers think they only need to buy $1 million worth of property and replace their equity. But that's actually not true. They need to buy $2 million or greater property value, which means that they need to use their equity and they need to either add more cash to the exchange, or use a loan. So if they don't replace that loan, that's all considered capital gain. That's all tax as boot. The next motivation would be diversification. So oftentimes somebody has owned a property for many, many years and they have their nest egg in one property. Well, if you were to leave the state of California, your money can go a lot further in terms of number of properties. So you could diversify across multiple locations and geographic regions and just get embedded diversification that way. Secondly is consolidation. So sometimes investors, they have multiple properties all spread out and they want to consolidate into a single property or single area, and you can swap properties and do so and consolidate your assets. Other motivations include cash flow. So oftentimes I talked about the California cap rates. Cap rates in California are low. meaning valuations are very high. So your income relative to your value is very low. So you can leave the state of California and get higher cap rates. I would also say, when you're presenting a team of professionals to a client, it's not a bad idea to have out-of-state listing agents or out-of-state buying agents that you can work with, that you trust, that you can utilize to offer a full suite of recommendations to your clients. And then management relief in estate planning. So we're going to talk more about the DST as it particularly relates to estate planning in a couple other slides. So let's see here. We'll go past this slide. We'll keep going. I thought some of these were hidden. So yeah, you can keep going forward. Keep going, please. Common impediments. 3 major questions that we get from clients when we're working with them. 1, I don't want to sell and buy somebody else's problems. So inherently, they're just going to stay in their property. They don't know what they don't know about another property. They know their property. They know what they have to improve it. They know what they have to pay in property taxes, insurance, maintenance costs. They know their tenants, but they don't want to exchange out of that because they don't want to buy somebody else's problems. Other impediments for not selling. The 45-day timeline feels too short. So how can I find properties in 45 days? That is very competitive. I don't see a lot of inventory in my market. These are all things that an investor would say, hey, I don't want to sell. Next is, I don't want to own a property here anymore. So they want to get out of the state. California, we work with investors all the time who want to exit out of the state of California. They want to get out of, they feel like it's tough to be a property manager. They feel like the tenants have all the rights. And these are just complaints that we hear all the time from investors, and they want to leave the state. Other impediments include interest rates are too high now to replace my current one. So if you had a 3% interest rate in COVID, well done. If you can, I'd recommend to keep paying that debt down, but don't prepay it because it's great to have that interest rate. And it's hard to replace that interest rate right now. But if you were to sell, you have to buy, again, equal or greater value, and you have to replace your debt. So you would have to get new debt at current interest rates in this environment, which is very difficult. And I think that the DST is not built to solve 100% of the problems, and I'll be upfront about that. And we, talking with an investor in 20 minutes, can figure out, yeah, this is actually not the right structure for you. And this is where I think you're better suited. And we have that conversation all the time with investors. But sometimes there's no overlap. And I think the DST can be situated to solve those impediments that we talked about in certain circumstances. So I would say we can go through this, and if there are any needs, then we can have an individual personalized conversation with clients, thinking about how does this pertain to your specific situation. So the Delaware Statutory Trust is a entity wrapper that has a revenue ruling dated 2004-86. So the IRS has legitimized this as a structure that qualifies for 1031 exchange. Accredited investors can fractionally purchase institutional quality real estate within a 1031 exchange. The Delaware Statutory Trust can own multiple properties or single properties. Oftentimes, think of it as a 250-unit apartment complex, or think of it as an Amazon distribution facility, or a portfolio of grocery stores, maybe 10 grocery stores inside of this one trust wrapper. An investor is buying fractionally a pro-rata interest of that real estate. So they own the real estate in the trust, and they own the income from the trust. Additionally, real estate is stabilized. So a sponsor, who's also the trustee or the manager, they're going and buying the real estate. They then package it into the trust. They then bring it out through advisors or broker dealers like here, and they want us to offer that investment to their clients. The real estate, though, is cash flowing. It has trailing performance. It has a track record that you evaluate. Lastly, pre-identified investment objectives. So every investment is going to have a projection of time horizon, of hold period, of income, of targeted returns. And as an investor, you know that before you ever go into the trust. It's not a mutual fund that you invest blindly and then they go in and buy properties. The properties have already been identified. They've already been structured and bought into the trust, and you know exactly what you're buying. And then you can evaluate exactly what you're buying. So within the 1031 exchange, most commonly you're going to go from a real property to sole ownership property. So you sold a duplex and you buy a duplex and you buy in your local market. And with a DST, it's going to look and feel very similar, except that you're buying fractional ownership interests into larger scale of properties. And it's like a mutual fund in the sense that there's other investors who are coming in and who are investing alongside of you. So as an investor with, $100,000, you could get exposure to 10 grocery stores fractionally. You own a very, very, very small percentage of those 10 grocery stores, but you're getting diversification across those tenants and those locations. There's a trustee beneficiary relationship. So I talked a little bit about the trustee, who's the sponsor. They manage the trust. Think of it as a living trust or a grantor trust. A lot of investors will have those set up for their families. The trustee is the taxpayer, and they're making decisions over the trust. The beneficiaries, in this case, in the DST, they own the real estate of that trust, and they are earning income from the trust. Typically, sponsors' responsibilities include purchasing the property, managing the property, and selling the property. So they have control over that. An investor is going to get income, they get tax deductions, and they get the appreciation, the growth of the real estate in the trust. The investor is also reporting income on Schedule E. So it's going to look and feel very similar. They report their revenue, their expenses, they get their depreciation. So advantages of the DST can include diversification. A DST could own 10 properties inside of it, or you're not even limited to how many DSTs you go into. If I thought there were 10 good DSTs, then you could go across 10 different DSTs and diversify across those properties. Now you have to still, if you're gonna, within your 1031 exchange, within your 45 days, you can buy as many properties as you want. But if you're going to get past day 45, then you have to be considerate about the 1031 rules, including 3 property rule, 200% rule, 95% rule. So those would apply still. Professional management. The properties are managed on an investor's behalf. Institutional properties can include apartments or grocery stores or distribution facilities. The debt can be customizable. So the debt, you can buy dollar for dollar how much debt that you need in the property. So if a taxpayer came out of their exchange and they paid off a $600,000 loan or a note, you could buy in the DST exactly $600,000 worth of debt. If you bought more than that, then that would be a way to add taxable basis, depreciable basis for the exchange. But I guess the net out is that you can buy dollar for dollar how much debt you need, and the financing is able to be customized. Additionally, the debt is non-recourse. So as a taxpayer, you're not having to go out and get that loan yourself. And interest rates are high, yes, today, but also the advantage of getting to assume a loan that's non-recourse to you that you don't have to sign on and write as a liability on your balance sheet can also be a way to optimize your balance sheet and then replace your debt. And then go to the next slide, please. So in a 1031 exchange, as we're talking about, you need to buy equal or greater value, and the DST can match that. It can get you exactly to where you need to be from a loan to value perspective. Next slide, please. Probably half of the DSTs in the market are going to have some type of loan on them. That loan will typically be between maybe 40 and 45% loan to value, meaning that a taxpayer is going to put down 55 or 60%. So these are not 80% loan to value deals typically that a taxpayer is going to be in. They're going to put a lot of money down typically. The other piece of it is the other half of the market is all cash. So unencumbered real estate where there's no loan associated. We evaluate all the different types of real estate, but I think the non-recourse structure can be useful for a taxpayer. Other advantages include 1031 efficiency. So you can go to the next slide, please. The same rules apply for 1031 exchange. You have 45 days to identify from the date of closing. You have 180 days to close. Within the DST, and maybe one more slide, please. Within the DST, you could identify property and close in 2 to 3 business days. So you're not having to go under, 30, 60, 90-day contracts to close on the property. You can close in 3 business days. So if it's day 40 and your taxpayer does not have a property that they have found that they like, and they're faced with either paying capital gains or investing into something that is hands-off, they have that option. The DST can be a solution. I've seen investors close on the same day. I think it was with Exchange Resources where a client of ours had closed that day on an investment. Now, it's not advisable. I think it saves a lot of heartache, but it can get done.
Next.
Yeah, next please. Additionally, the limited liability wrapper is going to be in place with the DST. So you could hold the real estate in your name if you're able to within your 1031 exchange, right? You need to sell as a individual taxpayer, and then you can buy as an individual taxpayer in your name. But the DST acts as a wrapper. So your recourse as an investor is your investment. So it's something that were to happen, the lender cannot come after your personal assets outside of the structure. Additionally, cost basis and depreciation. So the DST acts as a way to defer your capital gain. You still get depreciation. It's going to feel very similar, as we were talking about earlier, to just owning sole ownership real estate. Additionally, estate planning. So we think about, again, somebody who's thinking about estate planning, the average age of our client is probably 72 years old, and they're thinking about this transition of their wealth. And the DST interest can be fractionalized amongst all the beneficiaries. So you can say, hey, I have 10 beneficiaries. I want 10% of my real estate in the DST or in the trust or across all my trusts to go 10%, 10%, 10% to all the beneficiaries. So it's a way to simplify the estate planning process. And then when the taxpayer passes away, each beneficiary inherits their percentage of the real estate. And when the properties are sold, they get a step up in basis. So then they can each go their own direction. So it becomes this way to plan for the future, while in the interim, you're still as a taxpayer getting income. You're still invested into real estate. You're deferring your taxes. And then at your passing, your heirs will kind of kick into that estate plan. The 721 exchange option, we have some more time actually than I thought. So we can go into the 721 exchange and specifically how that is its own unique strategy, but also plays alongside of the DST nicely. And next slide, please. Considerations. We talked about the advantages. What are the disadvantages? The number one reason why an investor would not do a DST is because of the illiquidity and the lack of control. Lack of control is a big piece. Think about right? I mean, we all like to be in control. A taxpayer, they own real estate for 30 years and they do that really well, and that's their expertise. Giving up that control can be difficult. Now, that can also be an advantage to some people, but the control piece is the number one reason why they would not do it. Liquidity is going to be different than, say, in other securities like trading Facebook or Amazon or a stock on the NASDAQ. Liquidity comes from when the properties are sold. So hold periods at minimum are going to be 2 years, and they can be up to 5 to 6 years, maybe 7 years for a specific DST. So liquidity for the taxpayer happens when the properties are sold. Additionally, in the DST, it's not without risks. There are the same real estate risks that apply to sole ownership real estate apply to the real estate in a DST. I like to say that there's never been a DST that has failed that has really good real estate. DSTs fail, investments fail when the real estate is not sound, when you buy the property too expensively, when the assumptions are aggressive, when something happens to the market. Those are all reasons why real estate fails, and the DST is not protected from that. And then through costs. So the seller, or in this case, the sponsor, they're going to pay costs. So the investor, you want to look at the all-in price that you're paying for that property. We can dive into that a little bit more on the evaluation and underwriting side, but there's an all-in price that you're paying. And the question is can you sell this property for more than what you're buying and paying the all-in price for this property? And then debt structures. So I feel like the market is pretty well balanced, but in terms of debt, let's say that a DST had a 40% loan to value, and you as the taxpayer had a 30% loan to value on your relinquished property. Well, investing only into that 40% loan to value DST, you would pick up additional debt. And that would be additional debt that you would need to replace on the next 1031 exchange. So it's something to think about. Not everything is going to be through that lens, but it's a factor to consider.
Chris, I have
Yeah,
a
sure.
question. So, on the liquidity okay, so mom and dad do a 1031 exchange, they do the DST, mom and dad passes away, it's an interest, if they pass away. Can the kids sell, they're the beneficiaries, can they sell at any time that their mom and dad's portion?
In the DST, no.
No, okay, that's what I.
That's right.
Okay,
That's
so
right.
they cannot until it actually,
Till the property is sold.
okay,
The 721 exchange. Yeah, so I'll just kind of like full stop, like that's a consideration. The 721 exchange is an additional strategy that we can talk about, where it's now inside of a REIT, and in the REIT, you can sell. There's not the same hold period restrictions in a REIT that would exist within a DST. The REIT has been built to provide liquidity to investors. So that can be a way, if that's a concern, that can be a way around that.
okay, and then you mentioned like risk factors, even with DST properties. Would an example be like during COVID, I noticed a lot of commercial strips, commercial malls, whatever. They lost their tenants because of COVID, properties depreciated. Would that be like a scenario, a situation where would you say
Exactly.
that?
Yeah.
The effect of the property or.
Exactly. Yeah, exactly. So
Kind of out of everybody's control. I mean, this is just.
yeah, it's out of everybody's control, but yeah, let's say like if we think we didn't own any office properties in San Francisco. There were reasons why we didn't buy in San Francisco prior to COVID, but let's say we did. Well, now you have an office building and all of your tenants are on these short-term leases and they all vacate the property. Well, now you have a vacant office building. You're still responsible for your mortgage, your property taxes and insurance, and you have no income coming in. So like
So you could be affected depending on the scenario, economy.
Yep.
Situation.
And we're gonna spend some time on due diligence. We feel like we are positioning our investors in the best spot to realize success in their investment by our due diligence. So we're vetting these properties, vetting the markets, vetting the underwriting, looking at certain types of tenants that would do really well during recession. And we're looking at, and we're also evaluating and knowing what types of asset classes or properties perform very poorly. So like hotels, if our macroeconomic view of the world is that we're headed to a recession or we're going to go in this business cycle or higher interest rates are going to impact consumer spending or business travel, then we want to stay really far away from hotels because hotels, they have these daily leases and those leases expire every day. So when less people travel, the hotels get really impacted from an occupancy standpoint, from an income standpoint. So we don't want to have exposure to those types of properties for our clients. So like that's, I love that question. But yeah, that's a great question. So we try and protect our clients through our due diligence. So the differences, but then also the similarities of sole ownership and DST real estate are income, the appreciation you share in that, you get the depreciation, your tax basis goes forward with a DST similar to a sole ownership property, and you're in line for the step up. So the DST fits in the same way as sole ownership real estate alongside of your estate plan in those ways. What the DST has that sole ownership real estate does not have is management responsibilities or no management responsibilities. It's fractional amongst your beneficiaries, and it can be immediately assignable, distributable per the estate plan. So those are things that the DST has that I would say sole ownership properties don't have, or the main distinctions. So common commercial real estate asset classes that include medical, industrial, investment credit, net lease, apartment, office, student housing. As an investor, you can then go and buy just sole ownership property. You could buy a 300-unit apartment complex. or you could buy a single Dollar General or a single Tractor Supply. When it's packaged into the DST, and you can go to the next slide. When it's packaged into the DST, it's the same thing, but you're just buying fractionally. Next slide, please. You could also, instead of buying a single property, you could buy a portfolio of properties in one DST. And then go ahead. Or you could do multiple properties in your local market and in the DST. One of the common things that we've seen with real estate investors and working alongside their financial professionals and their real estate agents is last year I was working with a client who sold an apartment complex, and they knew they wanted to buy quick service retail or quick service restaurants in Texas. So they worked with their local agent to buy those properties. They then had this debt liability, this mortgage that they paid off that they needed to replace. So using the DST to replace their mortgage liability across a lot of different properties, upwards of 10 or 15 properties, where now they're diversified to have a mix of tenant quality and locations. And they were still able to buy 2 ownership properties in Texas. So that's a way that we see, and you're not limited to buying local and then using the rest of your exchange into DSTs or vice versa. So you can combine those 2 strategies. Now the question is how do you navigate? And one of the purposes that I was describing earlier for JRW is to source the highest quality real estate for our clients. And at the bedrock of our advice, understanding the capital gain and understanding how their property is performing, working with a team of professionals to get the listing. The number one thing is you need to find good real estate. And how we navigate the real estate market is through working and evaluating all the different sponsors that are in the industry. And you can go to the next slide. Go ahead to the next one, please. So here are some of the major sponsors. These are blue chip sponsors in a lot of instances. You have, JLL, you would probably recognize Cantor Fitzgerald, Inland, Brookfield, Livingston. I would say today, there's never been more of a financialization or the consolidation of large asset managers of money and wealth and real estate that have started kind of tipping their toes in the DST space. Our office, we've been around longer than most. So we've seen going through the Great Recession, we've seen going through COVID. We are not the largest marketing company, but we evaluate a lot of real estate on behalf of our clients. Next slide, please. The current DST market at any point in time is between 60 and 100 investments. There's probably between 40 and 60 active sponsors. The asset classes can vary between DSTs. I would say a large majority is going to be multifamily. So a quarter of the market will be multifamily apartment complexes. 20% is going to be retail, and then 40% is going to be industrial. The other types of asset classes that exist in the DST could be hotels and self-storage and senior care, all different types of real estate that qualify for tender of exchange. Remember, the rule is very broad, like kind property, but that can exist within the DST. Now, our analysis process is to look at everything we can get our hands on. We review 100% of the deals that are in the market. We will filter through the initial deals that have glaring red flags. An example would include an outstanding environmental site assessment. So a phase 1, right? If it came back dirty that there was this environmental liability, that would be a big deal. Because then the taxpayer is responsible for the cleanup. That's a massive thing that would preclude us from just saying no to the deal right off. Secondly is maybe there's risk with the asset class or the area, or maybe the sponsor has a bad track record. Those are all things that we consider when we're doing our initial screening. Next is we're going to evaluate the price that investors are paying for the real estate, the all-in price. We're going to evaluate the underwriting or the projections. So what are the rental rate projections? What are the operating expense projections? What are the occupancy projections? All things that matter when underwriting and evaluating real estate. On a commercial scale, we're going to evaluate those and we're going to compare those to the local submarket. I like to say that we can review any submarket or find data for any submarket for any asset class anywhere in the United States. So if it's a multifamily apartment complex that we're evaluating in Raleigh, North Carolina, we're going to look in Raleigh and we're going to find where our local competitive properties at and do a competitive market analysis. These are all things that you guys are doing, but we're trying to project into the future and say, how is this property going to perform into the future? After that, that's going to leave us with maybe about 15% of the deals that pass. And if it's a multifamily property, we're going to go do a site visit. So the last property that I went and visited was in October in Phoenix. I walked the property, I visited the property manager, I walked local comps and secret shops and got a feel for the other competitive area, other locations in that market. And then after it's all said and done, we're going to be left with probably between 5 and 10% of the deals that actually pass our analysis process. So last year, we recommended 7% of the investments that my office reviewed. And not all 7% will get presented to a specific client. That's just 7% of what we felt like are good investments that could meet the needs and goals of our clients. Then it's up to the advisor or working with the client to understand really what their situation needs and what is suitable for them. Underwriting categories include price, operating model, and exit strategy. So the price is like, what are you paying for the property? What's the all-in price? The operating model is your ability to increase your net operating income. An investor has two ways to drive the value of their property. You can compress your cap rates, so your cap rate can go lower, or your valuation can go higher, or you can increase your net operating income. So underneath those questions, there's all these variables, and I don't want to act like I can predict where cap rates are going, but I feel like I can really understand and dig into an operating model and understand how can I impact and grow the net operating income of the property. And the core value that Jeremy provides is understanding these questions. Now, it's probably a 30-hour project that we're going through to understand this, but it's really important to dig in and dive into those questions. Now, we talked about REITs, and I think we still have some time, so we'll go through the different types of exit strategies. You have a strategic exit strategy, which is where you know who the buyer is going to be. So you go to the DST, you 1031 to the DST. A REIT is going to buy or is intending to buy that DST. And that's the strategic exit because you know who the buyer is going to be. Typically, the REIT will form the DST with the intention of acquiring it in anywhere between 2 and 5 years. And they build the DST because oftentimes they can't do a direct 721 exchange with investors. The DST becomes the most direct pathway into a REIT if an investor is looking for liquidity, for estate planning benefits, owning the shares of the real estate investment trust. Next slide, please. Market-driven exits are where you are going to buy and hold the property. So typically, the hold period for a market-driven exit strategy will be dependent upon the lease length or the loan length, typically between 7 and 8 years, I would say, where you buy the property, the trust, they manage it, they then will market it through a broker opinion. They get a broker opinion of value, they list it, and then a REIT or a DST or a family office will then buy that property. So that's a market-driven exit strategy. And I don't think there's one strategy over another that it kind of depends on what the client is looking for. But I would say that there's definitely more certainty around knowing who your buyer is going to be. You don't know the price they're going to pay, but you know that they intend to buy that property. Now, with a 721 exchange, it's where there's a contribution of profit. So historically, 721 exchanges are used for business mergers where a business is contributed into another partnership. And in the same way, real estate can be contributed into a partnership without paying capital gains and deferring your capital gain, deferring your depreciation recapture, keeping your basis the same. It's tax deferred. Inside of a REIT, you also get diversification. So a REIT, let's say a DST has 10 properties and it's a total portfolio size of 100 million. A REIT may be a portfolio size of 1 billion or 2 billion of total real estate exposure. You get the fractional liquidity. So REITs have what's called share repurchase program. And this is back to your earlier question. REITs will allow redemptions of investors. So as a taxpayer, I could say, hey, I want to redeem a share or 2 shares or my shares. Now, if I'm still alive, that would be taxable to me. But if I were to pass away, then my heirs, they get their shares distributed to them or assigned to them, and then they can then liquidate independently of one another and receive the benefits of the step. And then lastly, estate planning, which kind of fits into all those things. But still with REITs, it matters the property, the location, the tenant, the industry. We talked about the DSTs. There's probably 83 DSTs right now, I think. There are 11 REIT strategies. So there's 11 REITs that are with blue chip names like Ares and Cantor Fitzgerald and JLL. They all have these REITs that they manage. And these REITs are owning collections of properties. But my biggest thing when evaluating REITs is this a REIT that I'd want to be in long term? Because you're tied to that REIT. Once you go into the REIT, you cannot do another 1031 exchange. That's the end of the road for the 1031 exchange once you go into the REIT. So the REIT is not for every taxpayer. The REIT is for somebody who really is just hands off. Like this is going into the whole strategy. This was their last 1031 exchange, and they were comfortable with that. So like I say, like the average age of our investor is 72. Somebody who's going to go to a REIT is maybe 80, right? They're in a different stage of life where they really are not going to sell unless they don't have to do their 1031 exchange. A DST though can preserve the 1031 exchange option. So you could go into the DST, let's say it's day 40 and you didn't have an option. You can 1031 to the DST, you invest for the whole period, call it 5 years, and then you can go back into sole ownership property. You have that ability. So you can go back and forth, yeah. Yeah, and the transition out of the DST would feel very similar to selling your own real estate, where you set up an exchange account, the money's wired over, you do the 1031 exchange, the same rules, all that applies coming out of the DST. Yeah.
So there are multiple people can join the DST, right?
Yes.
So how did they decide what the price to sell that product?
The sponsor or the seller is going to do a valuation when the properties are sold. So
Everybody has to agree to sell it.
no.
No.
That would actually be, so we saw that that actually happens when you have a tenants in common structure, where you need to get mutual consent amongst the tenants in common. Tenants in common were very popular in the mid 2000s, early 2000s. The DST is different from tenants in common in that the trustee is making all the management decisions. So you like there's as an investor, maybe another way to look at it, you're really trusting the manager, the trustee, to execute well, to manage the properties well, and to make a decision on when to sell the property.
So if the manager decides to sell it, and then one of the member who bought the trust, they are not ready to do 1031, what will happen? They just have to pay the tax.
Yeah. Now, we see typically sponsors will give a 30 to 60 day heads up to investors when they're selling their property. So they give some heads up, there is some advance notice typically. And an investor could go back into sole ownership real estate, or they could roll into another 1031. For an investor who is kind of just ready to just be out of hands up, for an investor who's willing or ready to be out of active management, and they're going from DST to DST, and they want to keep doing 1031 exchanges, that is never really an issue. For our office, we've probably gone maybe 2 weeks without having a property that we felt confident in recommending to a client. But generally speaking, there's a wide inventory list of properties. It's just a matter of which ones are going to be good real estate and meet your needs, meet your client's needs.
Is there a limitation how long the manager can keep that DST property?
It will be determined based on the length of the loan. So if there's a loan on the property and it's say a 10-year note, then they would have to sell the property before the 10th year.
I'm sorry. At that time, the investors, like you said, they're given like 60-day notice or so. They can either find another property or they can choose to just withdraw and get out.
Yeah.
Okay.
Yeah, they could 1031 locally, they could 1031 to their DST, or they cash out.
They cash out, but then they're subject to
Then there's tax. Yep.
I have a question. But to 1031 exchange, we need to own the property for 2 years, right?
Yes.
So what if we join the DST less than 2 years, and then the manager want to sell it?
They will hold it for at least 2 years. So we,
They will wait for you.
Yeah.
To sell.
what we see with managers is that they will, typically a DST takes about 30 to 60 days to fully raise money. So if they're raising $10 million, it takes 30 to 60 days to raise that money. Now, all the investors are in the DST and the manager will hold the DST for at least 2 years after the date of the last investor.
Oh, so all the investor has to join at the same time.
No, no.
No?
So the DST's already been acquired by the trust. The manager, let's say there's a loan on it, okay, there's a 50% loan on the property. And then the manager owns the other half. They own the equity of the DST. And they own what's called class 2 beneficial interest. And then as an investor invests $1, the manager is selling them class 1 beneficial interest. So they're switching hands. Now the investor owns part of the DST, and the manager is selling its interest out to investors. I can maybe say that another way. There is the manager, the trustee, owns 100% of the property or the equity in the property. And then as they raise money, they're selling the ownership that they have to investors. And then investors are buying. And investors, each one in the DST has its own individual tax basis. So when an investor invests and the money's wired over, they get a closing statement that day that shows that they bought X amount of property. So that satisfies their 1031 exchange. And the sponsor, they're still raising money for the other portion of the DST. So each taxpayer is treated individually. And you can get your closing statement and show that you completed your 1031 exchange while they're still raising money for the other portion of the property.
And Chris, each investor in this fractional, they have a different proportion or fraction for investing, because not everybody's investing the same amount, correct?
That's right. Yeah.
So,
Yeah, we'll see exchanges as maybe small as 75,000. And then we'll see exchanges up to 15 million. Like it kind of just varies widely, the types of exchanges and what the goals and needs are of the clients.
I have a question.
Yeah, sure.
Does JRW Investments have access to all the DST offerings in the United States?
Yes. Yep. So we evaluate all the investments that are available. We evaluate all the non-traded REITs. What we like to introduce ourselves as is we are a real estate due diligence firm. So we're vetting and sourcing and finding the right properties, and we're presenting the investments that we think are good investments to our clients. We will also, there's not an obligation to work with us either. So we're not signing anything with a client when we're introduced. How we get compensated is on the transaction. But up until that point, we're sharing our research. So if somebody said, I'll use like JLL because everybody knows JLL. A client wanted to go into JLL or they wanted our research, even though maybe we weren't recommending that investment. We would still provide our research to the client. Say, hey, this is the price you're paying. This is the strengths of the investment. These are the risks. This is what our opinion was on the investment. So we present all the research that we've done across the entire market for our clients.
Any Zoom questions? Anybody from Zoom have a question? Go ahead.
So it's general, so that means, out of the 80-some DST you're mentioning, you vetted and then picked out the 5% that are of good value. And those are the ones that you offer to the clients to go in. And then the different DST out of those 5%, they have different, maturity date or the loan date. And then you can pick and select out of those DSTs.
That's right.
And then also each individual DST, they also have different focuses.
Yeah, so DSTs could, let's say one is an apartment complex and it owns a 300-unit apartment complex. So now there's a property manager in place of that property and they're doing all the leasing and the site, the unit tours with the tenants. And then as an investor, you're responsible for the expenses of that property. Well, that could contrast, say, a Kroger grocery store, where Kroger is responsible for all property taxes, insurance. They pay a lease on the property. So now what you're betting is what's Kroger's ability to pay their rent or Amazon's ability to pay their rent. And they have this length of lease that they're contractually obligated to pay the rent. So those are two different lease structures, two different types of investments, and they even carry different, risks with those investments.
Okay, so for the diversification purposes, we have DST for multifamily, one for grocery store, and one for mall. So you're diversified in that asset class, but you can also diversify by buying 3 different types of
Yeah,
DST?
You can, yep, exactly right. Yeah, so you can, if we thought there were 5 good DSTs to go into, then you could diversify across those. What I'll say though is, so our due diligence department was enacted in 2007 by Joshua Ungericht, our CEO. And today I lead that department. We used to be like a lot of other, I think, advisors or broker dealers, where we would offer a menu to clients. We would say, hey, diversify across these 10 different sponsors and hotel and senior care and hospital, like all the different asset classes, diversify. Well, what we found was that diversification through the Great Recession did not actually protect our clients, because any type of economically sensitive property got hit really hard and that dropped value. Well, the asset class that performed the very best, or the characteristics of properties that performed the very best, were properties that were bought at a great price, that had room to grow rents and increase your net operating income, or properties that had long-term leases with stable tenants. So if you bought a Dollar General in 2006, they paid their lease for the next 6-7 years, and then you sold in 2013 or 2012, you got your money back. So like that type of investment is a different strategy than, say, multifamily or hotels or different property types. We look at all different types of real estate, and we are trying to figure out where's the value, what can go wrong, how can we protect our investors through different cycles of the economy. Yeah.
Question. So I don't know the terminology, so I'm just going to use what I go in. So when it reaches the maturity, because you say you have to hold on for 5, 7, 8 years. Once it reaches that maturity, are your shares distributed out and they close out that EST and then you exchange into the new one?
That's
Is
right.
that how it works? Okay.
That's right. So DST that had 10 properties, they would probably sell it to a buyer, a family office, a fund, REIT. I would pay and purchase all those 10 properties at the same time. So you're not selling those properties individually in a single DST, you're selling them all together. Whereas if you were spread out across, say, 10 different DSTs, you have 10 different maturities and 10 different exchange accounts that you're opening up and working with.
To be the member, to be the investor, do they need to have the 1031 exchange, or can they just go straight investment on this DST?
So I think the question was, can you can invest $1031, but can you invest cash outside of
Yeah.
1031? And the answer is yes. I actually would probably recommend against it typically, depending on certain instances. The bulk of our investors, the DST is very well suited for $1031. But I think with cash investments, there are better alternatives that give you more flexibility, that don't restrict you to the same timelines that a 1031 vehicle would be beholden to. So as part of our service to our clients, we evaluate REITs, limited partnerships, and opportunity zones and sole ownership properties. We evaluate all different types of real estate, and the DST is a tool for the 1031 investor, but for cash investors, I think there are different and better preferable vehicles.
Thank you.
Yeah, thank you guys. This is
That's
great.
so informative. Wow. Thank you.
I would say, yeah, see, my contact information was up on the screen kind of throughout. My business cards are in the front. There's also some brochures. We're just up the street, our home office. And I would also say the ideal relationship that we could have is the next time you go into a listing meeting, we can recap your investor's scenario and just strategize. And that doesn't have anything maybe to do with ending up in the DST, but it's understanding your capital gain, their situation, what options they have at their disposal. And exchange resources would be a great tool for that as well, as you go into these meetings with clients. And I really think that that's the distinguisher when you're competing against other listing agents, is understanding and being able to communicate from an investor standpoint to the real estate owners.
But you had that, I remember you got CPA, financial advisor on the circle. So you're in the center, so you're like the quarterback. But you do have some knowledge from the other aspect where you could plan along with them. Is that what you're saying?
Yeah, we feel like we can complement the existing team that is already in place. Like I could represent stocks and bonds and mutual funds to a client, but I think I really know real estate and I want to stay in that lane. We don't want to, we think we add value to the financial advisor because we underwrite all these deals and evaluate all these deals. In the same way, like a CPA, that's our background. We are not going to file their tax return. We're ultimately going to defer to their CPA when it comes to tax advice and entity structurings and all those things. But we can have a conversation and at least point them in the right direction and saying, yeah, this is something that you need to get more advice on, or we've seen this done before, so need to confirm with your CPA, but like we can, play the quarterback, I guess is a good way to say it.
But you can't spot where a situation where it doesn't make sense for you.
Yeah. Oh, yeah.
Consult with the CPA to get the detail.
Totally.
Kind of like,
Yep.
okay.
Yeah, I like to think of it's like hand grenade math. So we'll understand what the property can sell for, back of napkin, what their basis is in the property, based on how long they've held it, the improvements they've done. These are just kind of like high level things. And it's something that we are always going to defer to their CPA for, but it gives an idea of ballpark within a boundary of 5 or 10% difference. Is there a need for the 1031? Or no, there's no need for the 1031. You don't have any capital gain. That can be really clear, easy to spot out, just through an initial conversation. Yeah.
So when it matures, they're sold out. You go in with 1 million, 1031 1 million. So what can you expect the report to say for the appreciation or the depreciation of the final numbers?
Yeah, I would say it depends on the real estate that you're buying. So with multifamily, I kind of think of it as a stock in your real estate portfolio, where it's more of a total return type of investment. Multifamily, because of the shorter term leases, you have this inherent rollover every single year of potential vacancies and rent going down, all those sorts of things. But I think that you can expect higher returns over time, total return over time, because you can increase your net operating income. With net lease, that's like a bond in your portfolio where you're clipping your income, or we call it clipping a coupon. You get kind of what you expect because the rent is guaranteed by the tenant, assuming they're strong. And then based on the exit, we don't expect much appreciation from that property, but we think that it's going to be very stable and steady. So the different asset classes can have different return profiles. I would say with multifamily, we try and have a stress test of saying, what can go wrong? Where are returns for this investment? We would hope to see something in the high single digits or low teens IRRs, rates of returns. But it's all dependent on the specific type of property.
And we're also available to answer your questions anytime you like. You can give us
Yeah.
a call about 1031 exchanges, or Chris for DSTs, and our cards are up here. So whatever questions you have, reach out to us. We'll be happy to talk to you, to your clients.
Yeah, thank you
for
guys.
sure.
Thank you, Chris, Katrina, Michael, thank you. Oh my God, I know so much. Just real fast, I wanna, first thank all of you for coming today, but two weeks from today, Alba, Moy and I are hosting, Christy Canilli, ChatGPT AI, the latest.
Nice.
You need to know. This is an awesome class. She's been doing it on demand. She's been filling up the rooms. She's awesome. 2 weeks from today, August 13th. Be on the lookout for that invitation. Thank you again.
Thank you,
Thank you. That was really great.
Thank you.
Thank you. Thank you, everybody. See you next time.
Yeah.